Hi, good day. So today I just want to do a little revision video for you guys. I know that we have covered adjustments and you might be a little rusty, and we don't have time in class to go back over these things, and you will get questions on adjustments for your end of term exam. So this video will be here for you to go over, and you can rewind, fast forward, go back over it as many times as you want until you get it. All right, so we are going to go back over adjustments with respect to expenses and adjustments to revenues, right? Now, when we are talking about adjustments, remember that we are talking about any transaction that will lead to your expense or your revenues that may be out of the current accounting period. And we have to make an adjustment for that, right? What are expenses? Expenses, you might be familiar with expenses in terms of like your home. You would have a bill, your parents will have bills to pay, light bill, water bill, TNTech bill, you might have a cable bill, you might have an internet bill. These are bills that you are familiar with at home. But for a business, you will have those very same bills, but you will have other bills to pay as well, right? And these bills are the expenses of the business. And the expenses, once it is paid out of money the firm makes, it will reduce the amount of net profit the firm makes. So that is why expenses are recorded in the income statement or the profit and loss account, right? So examples of expenses, you have rent, water rate, insurance, motor vehicle repairs. There are many types of expenses. You'll have wages and salaries for your workers, and a very unusual one, in case you do find it, it's interest on a loan. So the firm will take out a loan, and the interest that they have to pay on the loan is considered to be an expense, all right? So those are just some examples of expenses. So something else that we have to look at is the double entry rules for expenses. So we know that when we pay an expense, it will reduce you will either pay with cash from the business, or you will either pay with money from your bank account. So from the time you pay from cash or from your bank account, it will reduce your cash or bank account balance. And remember, your cash or bank is an asset. And when your assets decrease, you will have a credit entry. And because the money is going towards the expense, you will have to debit the expense account. So the double entry rules for expenses are: you debit the expense account, whatever expense it is, whether it's water, insurance, rent, whatever expense the firm has to pay, you have to debit the expense account and credit whatever account is being affected in terms of cash or bank. Remember that your expense account is a nominal account and would therefore be recorded in the general journal and the general ledger. So the accounts for those would be found in the general ledger. Okay? Why we need to take into account adjustments. Remember that adjustments is even one of the stages in the accounting cycle, adjusting entries, right? Not all the time you will have adjusting entries, not all the time. So in the instances where you have adjusting entries, the reason why it has to be recorded, or the firm has to make some adjustment for it, is because of something called the accrual concept. Accounting throughout the world internationally have some rules that they abide by, and one of them is the accrual method of accounting, in that an expense must be reported in the income statement or the profit and loss account for the period when the following occurs, right? So once the expense occurs within that particular period, it must be recorded within that particular period. The benefit you are gaining within that period must be recorded within that income statement. So if you so happen to have paid for an expense for the following year, we are in 2018, and you paid towards 2019 expense, then you should not include that in the income statement for 2017 if it is a payment for 2018. So that is just an example, right? So that means that the accrual concept really is just that all income and charges relating to the financial period to which the financial statements relate should be taken into account without regard to the date of the receipt or payment. So it's only for that accounting period and not for any other period that you should be recording in the income statement. Now, types of expenses and expenditures, and I'm going to deal with that right now. I'm going to go straight to the January 2016 question on expenses. So this is January 2016, number 4, part B and C. I will do revenues in another video. So this little video here is just for expenses. So let's read the question. The Gargamel Company maintains separate ledger accounts for rent expenses and commission revenue during the year ended the 31st December 2015. Gargamel Company recorded the following information. So for the 1st of January 2015, rent was prepaid. So we are dealing with the expense of rent. So first and foremost, let us label the account. Excuse my handwriting, right? It's the rent expense account. Okay, so we have debit side, credit side. Now remember that the double entry for expenses are you debit the expense account, and in this case it's the rent expense account, right, for this question, and then you will credit your cash or bank account. Now, as this question did not specifically state that rent is being paid with either cash or bank, let us assume that it would be bank account, right? Because in reality, not many people are going to go into your landlord's business and just pay them $5,000 cash. Normally, you go to the bank and you pay it through your bank account, right? So your bank account balance is going to decrease once you make a payment towards rent, right? So let's look at this. The 1st of January 2015, the rent was prepaid by $600. So this was brought forward from the previous year, right? So this is brought forward from 2014. In other words, this prepaid amount at the beginning of January 2015 was actually paid in 2014, but it was prepaid for 2015. So in 2015, that would be looked at as if it is a payment being made. And remember, when we make a payment, what do? We debit the expense account. So let's go and debit the expense account. So it's 2015, January the 1st, and we'll see balance prepaid, brought down for $600. Okay, excuse my handwriting. So this is prepaid from the year before. Now during the year, there were two payments. June 30th, 2015, an amount of $5,000 was paid. So $5,000, right? And let's again assume that it is bank, and this is June the 30th. And then on the November the 30th, a payment was made for another $5,000, right? Okay, so that is what we have. Now, let's read on. Rent expense is $12,000 for the year. And remember, when we were teaching, when you all were being taught this in class, that you are at the end of the year, you are going to transfer what was supposed to be paid, right, to the profit and loss account, right? Only the rent expense that the firm benefited from for that accounting year is what would be transferred to the profit and loss account as an expense, right? So what you will find now, because it is an expense, you have to close off all your expenses at the end of the year. When you close off all expenses for the end of the year, what you will have to do now is credit the rent expense account and debit the profit and loss account. I really don't have much space here, so I'm putting it on top here, and this pen is not very clear, but I hope you get it. So at the end of the year, when we have to calculate the total net profit of the firm, what you will find is that you have to actually close off all your expense accounts and transfer them to the profit and loss account. So this is your end of year now. We have no more expense transactions to take care of in terms of rent. So what do? We have the actual amount that is supposed to be paid, right, for rent for that year, 2015. They are saying it was supposed to be $12,000. So this $12,000, as we said, we are going to credit the rent account, and we are going to put profit and loss account here, and this is for December the 31st, 2015. So we have recorded everything that they have given you. So what do we have here? We have on the debit side, we have an amount of 5 plus 5 plus 6, 10,600. And on the credit side, we have a value of 12,000. Now, 12,000 is how much you were supposed to pay, right? You were supposed to pay this amount. But how much was actually paid? The amount that was actually paid was actually 10,600. Now, if you were supposed to pay 12,000 and you only paid 10,600, then you're owing. Not so? You're obviously owing money, and the difference is 1,400. Okay? Now, we know that that is the balance owing, right? The balance owing at the end of 2015. So what do we have to do now? We have to actually balance the account, because the end of the year have reached, and we have to calculate the net profit in the income statement. So let's close off this account and transfer whatever we have to transfer, right, for the next year. So we put our totals boxes. Which side is the larger side? Credit side, you put the 12,000 here, as well on the debit side. Right, difference goes on the smaller side. This is the smaller side, so the difference goes on the smaller side, which is the debit side. So we are going to put that 1,400 here. And remember, we said that this is the amount owing, right? So we have, for 2015, this is the amount owing. It's still owing, so it's balance owing, carry down to the next year. The next year is 2016. So for January the 1st, what was owing at the end of 2015 is actually owing at the start of 2016. So this balance owing is being brought down from 2015 to the amount of 1,400. So we have completed this rent expense account for the January 2016 paper, question number 2. Yeah, part C. In another video, I will deal with part C, which is the commissions receivable, and that's it.